Boot tax and estate tax for 1031 exchange properties. Part 2 of 3. In Part 1, 1031 exchange, how savvy investors keep more capital working with this tax deferral tool. One area we discussed, among others, was tax basis step-up erases capital gains tax and depreciation recapture. In Part 2, here we will discuss very briefly about estate taxes and different state inheritance taxes. Then we zoom in on boot tax related to 1031 exchange properties. Coming up next in part 3, we will wrap up boot tax issues. 1. How does the IRS prioritize ordinary income tax, capital gain, cash boot, debt boot, and non-like-kind property? 2, why isn't boot automatically bad, and when can be strategically smart? Disclaimer: all information shared here in this article and in all blogs, case studies, and courses offered by the Ivy Group are for general educational only, not as tax, legal, or investment advice. Please seek advice from tax, accounting, and legal and other professionals. Estate tax. Step up in basis applies to income tax when an inherited property is passed to the next generation from the owner. But the estate tax is a separate and different tax system altogether. If your estate's total value, including the property, exceeds the federal estate tax exemption, 13.99 million in 2025 per individual, heirs might owe estate tax even though the capital gains are erased. 1. State rules. Some states impose their own estate or inheritance taxes with exemptions lower than the federal. 2. Risk of rule changes. Step up in basis is politically debated. Proposals have surfaced to eliminate or limit it, even though no law has passed yet. Boot tax. In 1031 exchange of real estate properties, what happens when less than 100% of the proceeds of the sale are used to purchase the replacement property? The short answer is, if you roll less than 100% of your net sale proceeds and debt into the replacement property in a 1031 exchange, the leftover proceeds are boot. Boot is taxable now up to the lesser of your realized gains or the amount of boot received. We will explain what constitutes realized gain later in this article. The rest of the gain stays deferred into the basis of the new property per IRS publication 544. How does boot show up? Cash, debt relief, non-like-kind property, so you can spot where your transaction might trigger it. Boot usually sneaks in 3 main ways. 1. Cash boot. You sell a property for $1 million, but only roll $900,000 into the new one. That leftover $100,000 is cash boot and taxed as capital gain. You take money out at closing, e.g., just reimburse me for my equity. The IRS sees that as taxable. 2. Mortgage debt relief boot. Say your old property had a $500,000 mortgage and your new one has $300,000 debt. Unless you add $200,000 cash to the deal, that $200,000 difference counts as boot. Important: debt reduction is treated as the same as receiving cash. 3. Non-like-kind property boot. If in the exchange you also get something that's not real property, i.e. personal property, equipment, goodwill, etc., the fair market value of that portion is taxable. 4. Closing costs and fees nuance. Certain expenses, broker fees, transfer taxes, title insurance can soak up potential boot. But if exchange funds pay for costs not directly tied to the sale, purchase, like loan fees or prorated rents, those can create a taxable boot. So the triggers are leftover cash, lower debt, or extra non-like kind, non-real estate property. Tax consequences when proceeds are underutilized. Recognize taxable gain. The lesser of A, realized gain, or B, net boot received. Cash boot is always taxable. Debt boot can be offset with additional cash contribution at purchase. Character of gain. Some or all of the recognized amount can be depreciated recapture at ordinary income tax rates, with any remainder as capital gain. IRS publication 544 has detailed recapture examples. Examples of cash boot and debt boot. 1. Cash boot from leftover proceeds. Sell relinquished property for $1 million, adjusted basis $400,000, no debt. Realized gain equals $600,000. Buy a replacement property for $950,000 and let $50,000 come back to you as cash. Boot receive $50,000 taxable gain, recognize $50,000 because it's less than the $600,000 realized. Deferred gain $550,000. New basis $400,000 minus $50,000 cash received plus $950,000 paid minus $1 million amount realized given up plus $50,000 recognized gain equals $350,000. Same result using IRS worksheet on Form 8824. 2. Debt boot, trading down in leverage. Sell for $1 million with a $300,000 mortgage paid off at closing. Equity, $700,000. Buy replacement for $950,000 with a new $200,000 loan. You use all $700,000 exchange cash. You reduce debt by $100,000 compared to the old loan. That $100,000 is debt relief boot, unless you bring in $100,000 extra cash or increase the new loan to keep total value and debt at least equal. Recognize gain up to $100,000, limited by realized gain per this article. How people avoid boot. Rules of thumb. Number 1, equal or greater. Buy equal or greater value, invest all net equity, and take on equal or greater debt, or replace any debt reduction with new cash. That combination eliminates boot cash and debt boot. Number 2, spend exchange funds on qualifying costs. Have your QI apply proceeds to allowable exchange expenses, such as broker fees, transfer fees, title insurance, etc., not non-qualifying costs, such as loan fees, reserves, etc., at closing to avoid inadvertent cash boot. Number 3, model it on Form 8824 before closing. Your CPA QI can run the exact lines 15 to 25 to see if any boot will be recognized. All like-kind exchanges are reported on Form 8824 for the tax year the relinquished property was transferred. The form walks through realized gain, boot, recognized gain, and your new tax basis. Recognized gain versus deferred gain, replacement basis. To see exactly how much is deferred, how much is taxable boot, and what your new basis will be, using Form 8824 framework for 1031 exchange, we need to first have these numbers. Sale price of the relinquished property, adjusted basis, value after depreciation. Debt paid off at sale, purchase price of the replacement property, new debt on the replacement property, any cash you put in or took out. The following example lays it out step by step so you can see where boot shows up, what's taxable now, and what rolls forward into replacement property basis. Example facts. Sale price, relinquished property, $1.2 million. Adjusted basis, $500,000. Mortgage paid off at sale, $400,000. Net equity proceeds available, $800,000. Replacement property purchase price, $1 million. New mortgage taken, $200,000. Exchange cash used, $800,000. Step 1, realized gain. Sale price, $1.2 million minus basis, $500,000 equals $700,000 realized gain. Step 2, compare debt. Old debt equals $400,000. New debt equals $200,000. $200,000 debt relief. Unless you put in $200,000 new cash, this is debt boot. Step 3, boot receive. Cash boot, none. You roll all $800,000 into the new property. Debt boot, $200,000. Total boot, $200,000. Step 4, recognize taxable gain. Taxable gain is the lesser of realized gain, $700,000, or boot, $200,000. Recognized gains equals $200,000. This is what you'd pay tax on this year, with some portion potentially depreciation recapture. Step 5, defer gain. $700,000 realized minus $200,000 recognized equals $500,000 defer. Step 6, basis of replacement property. Formula, basis new equal basis old plus gains recognized plus money paid minus money received equals $500,000 plus $200,000 plus $1 million purchase minus $1.2 million sale price equals $500,000 basis. So the new property carries a lower basis relative to its market value, embedding that $500,000 deferred gain. Takeaway: because the replacement property was lower in value and debt than the sale of the relinquished property, you trigger $200,000 of taxable boot. Had you bought a $1.2 million property and kept debt at $400,000 plus, all $700,000 gain would have been deferred. In a 1031 exchange, the boot is any cash, debt relief, or non-like-kind property you receive when the deal doesn't perfectly balance. Boot is taxable, so it breaks the full tax deferral. A few angles you can consider. Accept and pay tax. If you're fine with partial deferral, just recognize the boot as capital gain. Sometimes the amount is small enough that the tax hit is negligible compared to the benefits of the exchange. Reinvest more. You can sometimes avoid boot by increasing the value of your replacement property or injecting extra cash at closing so that you're trading equal or greater value. Structure carefully. If the boot is coming from debt mismatch, less debt on the replacement property, you can offset by adding cash to close. Plan for timing. If it's inevitable, you can factor the tax into your overall strategy. Sometimes deliberately taking some boot is smarter than forcing a less suitable property purchase just to avoid it. Use professional guidance. A tax advisor or qualified intermediary can help structure 1031 exchange transactions so the impact is minimized by applying qualified closing costs to absorb some boot. Sometimes the perfect tax deferral is not worth chasing. It comes down to whether you want to maximize deferral or optimize portfolio fit. Sometimes the perfect tax deferral isn't worth chasing if the asset trade is strategically better with a little boot. In part 3, we will wrap up these issues. Number 1, how does the IRS prioritize ordinary income tax, capital gain, cash boot, debt boot, and non-like-kind property? Number 2, why isn't boot automatically bad, and when can it be strategically smart? Applying the 1031 exchange and related tax and estate planning rules to specific transactions takes years of experience. It is one thing to list all the rules, but quite another to apply the rules to specific cases. Like playing basketball. Learning all the rules of the game won't get you anywhere. You need to practice over and again on the court. To win a game requires so many factors beyond experience: mental focus, teamwork, strategies, quick reaction, understanding the big picture, flawless execution, planning the details ahead. To learn how these 1031 exchange and related rules are applied in unique situations with moving targets and various puzzle pieces, you can access for small fees case studies. https theivygroup.com/course-category-deal structure-1031-exchange. A commercial real estate transaction is a multifaceted process that involves factors such as investment insights, financing, alignment of properties with client-specific needs, market analysis, savvy negotiation, communication, tax planning, and other related areas such as accounting, law, technology, and engineering. When you need to sell, buy, or lease, the Ivy Group is ready to help you reach your goals with more than 100 years of combined experience and expertise. Contact us with your next real estate needs. Disclaimer: all information shared here in this article and in all blogs, case studies, and courses offered by the Ivy Group are for general education only, not as tax, legal, or investment advice. Please seek professional advice from tax, accounting, legal, and other professionals. Thank you.